Last week, stock markets rallied, seemingly due to a sense that the interest rate hiking cycle is now over. Now, while this may well be the case, we think that it is far too early to celebrate. And in this Albert E. Sharp Model Portfolio Service video, we highlight 3 factors that investors may well be overlooking right now and why we think it may pay to be more circumspect as we head into the autumn. Now, we outline our cautious portfolio positioning for now, but go on to explain why we remain unashamedly bullish as we go into 2024 and beyond. Despite news of higher inflation from the US and another rate hike from the ECB, markets moved decidedly higher last week as investors appear to be betting on an end to the interest rate hiking cycle. Now, there is a sense maybe that inflation is now under control, and we certainly think that inflation will come down, certainly in the US, and of that we're confident. Why? Because of the dramatic shrinkage in the M2 money supply. End of debate there as far as we're concerned. But with equities now so close to all-time highs, one gets a sense that the markets are now pricing in a soft landing and interest rate cuts maybe. Be careful what you wish for. We think this only happens if the economic data starts to rapidly deteriorate. And our read on every comment from the Federal Reserve, the Bank of England and the ECB is that they are prepared to keep rates high for an extended period. And it's for that reason our caution right now, because as time passes, the higher rates impact more and more people, more and more businesses. This path isn't smooth. It's not linear, and that is often the assumption here. What you usually get is an inflection point in the data, and as we see it, a tipping point. And in short, we believe that a recession is coming, if in fact we aren't already there. And when it's formally confirmed, it won't be good news for stock markets. Now, we're not saying that there will be a crash. It just seems very difficult to make a case why share prices can move up and valuations expand in an environment of progressively worsening data and really a deluge of bad news. This all stems from the US consumer, the single most important component of global GDP, arguably. In the US, personal consumption expenditures account for about 68% of gross domestic product. Now, over the last few years, economists have been regularly surprised by the spending levels, which have consistently been coming above analyst expectations. The problem is, we think this is about to end, and it's been coming for a while. The message that we've been hearing loud and clear from the US retailers recently is that the post-COVID phenomenon of so-called revenge spending seems to be over. Target, the with nationwide stores across the US selling general merchandise, reported its first quarterly sales drop in 6 years a month ago or so. This follows similar data from Macy's and Nordstrom in June, with Costco also talking about trading down. Combine this with the evidence that 61% of Americans are living paycheck to paycheck, and you have to be worried about how the consumer can prop up the economy. Well, here's reason number 1 why everything could change very quickly. On October the 1st, after a 3-year reprieve, Americans are finally being asked to start repaying back their student loans. We're talking about 43 million people here, and it's a very significant amount of their already stretched paycheck. We think it's about $500 or so a month, and that's about 9% of gross income. So that's an immediate drain on consumption. Where does it come from? It's an immediate cut in revenue for retailers and service providers that benefit from this discretionary income. So it seems likely that restaurants, hotels, apparel companies probably are going to suffer. And for some, it could push them over the edge. Now, reason number 2 is the diminishing level of excess savings in the US economy. During COVID, with stores closed, consumers had no choice but to save what they received. This led to a build-up of something like $2.1 trillion of excess savings. Now, since the reopenings, this has been spent, and according to the Federal Reserve Bank of San Francisco, it's about to run out at any moment. In other words, $1.9 trillion of spending since mid-2021 has come from a pot that is about to dry up. Now, of course, Americans can still spend more through higher earnings, existing savings, or credit cards, say, but it just seems difficult to see how it won't have a negative impact. And the final reason is an amalgam of what the markets and data providers are already telling us. Inverted bond yield charts, negative revisions to job data, and weaker purchasing managers' index numbers all point to recession. One statistic that caught our eye was the GDP plus number that recently turned negative. Now, this number, developed by the Federal Reserve Bank of Philadelphia, is a measure of real output. It incorporates gross domestic income using a statistical smoothing technique and is effectively the same as gross domestic product. It's just calculated slightly differently. Now, although the composition might be a little complicated, the reading of it isn't. Consecutive quarters below zero suggest recession from data going back to the 1960s, and this is absolutely crystal clear in every reading that we've had since then. So one of the conclusions of this data is that when revisions have been made to the data, it should reveal that the recession actually started in Q4 of 2022. Recessions in and of themselves aren't necessarily bad news. It's the length and depth that one should be worried about. We find it difficult to find a good reason why the next recession should really be any worse than the average recession in the past, certainly from a stock market point of view. But however you cut it up, it seems as though periods of recession don't seem conducive for higher stock markets. And we can see this from the red columns over time for the S&P 500. This is measured on a log normal basis. Now that is why we've got a 7% cash position across the board. 5% of this has been taken from what would ordinarily be in the allocation for equities. We've also got a much greater exposure to long-short equity funds than ever before. Now, if we're heading into a period of turbulence in which some companies will struggle, may even go bust, then, well, rather brutally, the environment for making money on the short book is therefore much improved, and really we want a piece of that action. And this links to some degree to our overarching quality first philosophy. We only want exposure to companies that have got a competitive advantage, that sell products or service that people will always want to buy, often regardless of the state of the wider economy. Think Microsoft, think MasterCard, think Diageo, for example. We want exposure to companies that have got strong brands, deep moats, that can defend themselves from new competitors. We don't mind paying a reasonable price for these companies, but we certainly don't want companies just because they're cheap. We very much believe in cheap for a reason. It's usually why they're challenged and maybe highly cyclical, maybe highly heavily indebted, maybe reliant on a factor that's beyond their control, such as, I don't know, the weather or government policy, let's say. But if we're heading into a recession, why would you want exposure to companies that are only going to face more pressure? Downturns often lead to the weak getting weaker and the strong getting stronger, and we think that this simple fact alone is a huge support for our approach. It could be very rewarding. Now, although recessions might not be great news for the S&P 500 at the time, as we can see here again, of course the good news is that periods of recession are followed by periods of recovery, and that is good news for the stock market. And that's why, as we look into 2024 and beyond, we remain, as we say, unashamedly bullish. And we think that smaller companies could be one of the best ways to benefit from this recovery, and this is why we have plenty of exposure, and we may well add to it as well over time. Now, it might be counterintuitive to think that a recession would be good news for small cap stocks, but research from William Blair, reproduced by Global Alpha here, shows that at the beginning of the last 6 recessions, small caps materially outperformed their large cap counterparts, and they then go on to for the following 3 to 4 years. An explanation could be that as recession nears, the smaller companies are the first to feel the effects of the tightening economy. It becomes more evident in their financial performance, and as a result, sentiment sours, investors become more risk averse and value the perceived safety of large caps. Then as government policies become more stimulative, the small caps are among the first to benefit and the most noticeable to benefit. The prior underperformance maybe was seen as an overreaction, and the share prices come back and more than make up for the loss. Economic downturns frequently prove that human emotion can be the biggest driver for share prices. This inefficiency can be a source of fabulous returns. It's our job to find the fund managers who recognise this. Incidentally, the research shows that small caps tend to underperform in the preceding 2 years of a recession, which in fact is exactly what we've just seen. So if you think recession is imminent, you need to be buying in right now. There's no doubt as well that small caps are currently cheap relative to large caps and relative to history. And this chart here shows that the US is at an extreme level. And this chart shows that the UK is also pretty much at an extreme level too. Now the next chart is probably one of the single most powerful that we ever refer to, because it not only makes reference to the small cap effect, it also refers to the quality effect. This has been developed by AQR, reproduced here by Montanaro. There's clearly something going on, and surely something that must be learnt from it. In fact, what we would argue is that this is clear evidence that the market is inefficiency. This is evidence that a focus on quality and a focus on small caps produces excess returns. It produces alpha. Interestingly, a lot of our competitors have a much lower level of exposure to small caps, and one big reason we think is that the funds generally charge a higher OCF. Now this doesn't put us off if we think that it will be compensated by the return. A fund is only expensive if it fails to deliver returns, and you cannot know that until after the event. You certainly can't know it beforehand. Maybe this is the subject of a separate video. So really, to conclude, here on the Albert E. Sharp Model Portfolio Service Team, we're concerned that over the next few months, data will finally confirm that the US and most of Europe is in recession. We do see a tipping point coming, and that could send stock markets lower. To be clear, we are not suggesting that there will be a crash, but we do think there is a reasonable probability that we will have the opportunity to buy back in at lower levels. Then as we look out into 2024, the prospect of lower interest rates suddenly appears, the subsequent stock market recovery comes, and that nearly always follows a recession. And we think we could see new highs delivered. Now, in saying all of this, it might seem as though we're somewhat contradicting one of our favourite quotes. There are two people in this world, people who can't time the market and those who don't know that they can't time the market. Maybe there is a bit of a contradiction, but really what we're saying is that we think it is prudent right now to hold a bit more cash, and I don't think that's particularly controversial. The bulk of our returns really are going to come through the detailed research that we undertake and that we've conducted on the regions and the sectors and the managers that we invest in. And so maybe a quote from Nick Sleep and his wonderful Nomad investment letters probably fits best here. It's when he says, "The course of the market will determine to a great degree when we will be right, but the accuracy of our analysis will determine whether we will be right." In other words, we tend to concentrate on what should happen rather than when it may occur. So on that, if you want to hear more detail on our portfolio, our positioning, our philosophy, my name's James Crocker. Please get in touch and we would be more than delighted to tell you more. Thanks for watching.